office visit from 3 years ago that just fell between the cracks. And so I'll call the doctor's office and say, hey, check, and tell me if you owe $30 from 3 years ago. I'm like, oh, for crying out loud, let's get this thing taken care of. And that can really hurt your credit history. Okay? All right, the amount that you owe, the total amount of debt that you owe. And that's going to be your house, the debt on your mortgage debt, and it's going to be your car debt, and it's going to be your credit card debt. Okay? Anything that you owe. Your student loans will be on there. All right. All right, the length of your credit history, the longer the history, the better they feel about you. Okay? All right. The nature of the amount of credit that's being requested. How much credit are you requesting? Are you trying to get? What is the use of the credit? And what are the terms of the credit? All these things are important to your credit score. Okay? The types of credit that you've used in the past and that you still have on your books, really important to your credit score. Whoops. Yikes. Bear with me. Looks like we don't have, I'm not sure what happened to our animation here. We should have animation here, but it looks like we don't, so let's make sure we have animation here. Where's our animation pane? Bear with me here. All right. Let me get this thing working. Yeah, that works. That works. All right, so here's where let's get all these things going here. Sorry about this. Just bear with me for 1 second. This is a new chapter. All right, let's see what we got here. Let's get all these things copied in here. Almost done, almost done. Where did that go? Bear with me here. Almost finished with it. Hopefully this will be it. So click. Here we go. I missed one. That's all right. So you know that rules and regulations continue to be passed, and so here are the latest things. And the rules and regulations typically fall into, I think it says 4, but I actually think it's 3 categories. We'll see. All right, the first is disclosure rules. Disclosure rules. Tell the customers about the cost and the terms of a loan. Okay? And so here are some acts that deal with that. The Truth in Lending Act, the Fair Credit Reporting Act, the Fair Credit Billing Act, and the Fair Debt Collection Practices Act. So you can see from the titles what the effort is, what the focus is of these different acts, but they're all about telling consumers the costs and the terms of a loan. Then there's anti-discrimination legislation, and this prohibits categorizing customers according to their age, sex, race, or other what they call irrelevant factors, or denying credit. You can't classify them, and you can't deny credit because they fall into one of these groups. It's against the law. And so there have been lots of lawsuits that have been brought against banks. Okay? Then there's so in this area of anti-discrimination, the more important acts are the Equal Credit Opportunity Act and the Community Reinvestment Act. And then there's predatory lending. Okay? These are bad practices. So these are laws that try to limit or address bad practices like charging excessive fees or rates, or selling unnecessary products, Can you say Wells Fargo, for example? Let's make sure this thing is going. Yeah, we're still going. All right. Wells Fargo sold unnecessary products such as insurance, particularly to consumers with below average credit scores. So be careful when you check your balances and check your checking account. Make sure that you know where all of your charges are going. And so the Home Ownership and Equity Protection Act of 1994 was one of the acts that had to do with predatory lending. All right, let's shift over and look at real estate. Okay, real estate loans. So real estate loans are used to finance the development or the purchase of homes, apartment complexes, shopping centers, office buildings, raw land. Notice that agriculture is not in here. That is a different type of loan altogether. Okay, and real estate loans tend to be kind of unique. Okay, first of all, the average size of a real estate loan, and remember we're talking about more consumer-oriented real estate loan, more consumer-oriented loans in this chapter. So the average size of a real estate loan is large. It's typically, for the typical individual or family, it's the largest loan that they'll ever take out. Okay, and they also tend to have longer maturities than other types of loans. So a car loan, 4 or 5 years, a home loan, 15 to 30 years. Okay? Okay? With real estate lending, there's a big focus on the condition and the value of the subject property. Of course, they look at income, like they do with all loans, the capacity to pay, but they also look at the condition and value of the asset that is being financed. Okay? So that makes real estate lending really, really unique. All right, so unique aspects of real estate lending. And appraisals on the property are critical to the loan decision. Okay? And these appraisals have to meet industry standards and government regulations. And yes, appraisals became a source of difficulty and challenge back in the financial crisis. A lot of bad appraisals were done, and they were done in order to generate fees for appraisers. So the appraisal business is a pretty sizable industry. You have to take exams and be certified to be an appraiser, and then you're going to either work for a bank or you're going to be independent and you're going to do work for a bank, okay, or for an insurance company to get an understanding of what properties are really worth. All right, so what do lenders look at when they are assessing an application for a real estate loan? Well, the first is how much down payment is the borrower able to put in on the property? Okay, so we're looking at the ratio of the down payment to the purchase price of the property. Okay, and this is called the loan-to-value ratio. All right, and the higher the loan-to-value ratio, the higher the bank is, the more money the bank is lending compared to the value of the property. Okay, the riskier the loan is. Okay, and which means if the borrower is not putting a bunch of money in, then they are going to be less inclined to honor the terms of the loan, to pay the loan off. Okay. Now, lenders may be willing to give a mortgage loan customer a lower interest rate. This is something that comes in to the negotiation. You're more inclined to get the loan. You're more inclined to get a lower rate if you put a higher down payment down, and if you agree to use other financial services. Remember that CPA approach to valuing customers. Okay. So other things that the lender looks at, the amount and the stability of the borrower's income, that's always there. How much savings a borrower has, so you're going to be asked about your balance sheet. You're going to have to create a balance sheet. And you're going to be asked, how are you going to fund the down payment? Do you already have it, or is somebody giving it to you? Okay. Do you have a history of taking care of property? Have you owned houses in the past? Okay. And of course, when a bank looks at the property and looks at the appraisal, they're going to take into consideration what's going on to real estate in the local market, because if they have to repossess that property, they're not going to hold it The bank doesn't want to hold that property on their balance sheet. They want to sell that property. So they want to make sure before they loan you money that, that there's a really good case to be made that they'll be able to sell that property for a good price if they have to, if they have to repossess it. Man, this is challenging. All right. Okay, let's look at interest-only loans and adjustable rate mortgages and the mortgage crisis that happened back in 2008, 2009. So back when real estate, the last big real estate boom, we're back into it. Prices are high again, but the last peak was 2007, 2008, and prices were soaring, okay? And lenders were trying to figure out how they could make high-priced homes affordable. They wanted to keep the game going, all right? How could they make mortgages more accessible to families of modest means? And the way they did this is they encouraged people to sign up for adjustable rate mortgages called ARMs, adjustable rate mortgages, okay? And the sad thing is that interest rates were very low at the time and prices were very high for homes. And they're related, folks. When interest rates are low, house payments are lower, and so people will throw more money at a house. They'll bid the price up because the interest rate is low, and the house payment will be low, so they can afford to pay more for a house. So you had very low interest rates, you had very high home prices, and people were taking out adjustable rate mortgages when interest rates were low. So think about it this way. An adjustable rate mortgage is a mortgage whose rate is going to move with market rates. And if interest rates are historically low, are the odds that are the odds better that rates are going to go down or that rates will go up? And obviously the odds are rates will go up. And people did not take that into consideration as they took out these adjustable rate mortgages. Okay? So another financial innovation that was used was the interest-only adjustable home mortgage loan, otherwise called an option ARM. And so this combined two really bad ideas. Okay? An interest-only loan on a piece of property, on a house. Why would you do that? Well, if you're with an installment loan, a level pay amortizing loan, you're paying principal and interest. If you take out an interest-only loan, you're not paying any principal, so what happens to the payment? It goes down. That's why people do it. So they combine adjustable rate mortgage with interest-only mortgage, and they came up with the option ARM. Bad idea. So the borrower only pays the interest on the loan for an initial period, and then after that period, then you start paying interest and principal. And again, what are you trying to do? You are trying to lure people into borrowing money and purchasing a home at the lowest possible price or cost up front, but then you hammer them down the road. Bad idea. Okay, and so this was considered to be predatory lending because it was done to people who had low income, below average credit, and low education. They didn't know what they were getting themselves into. Okay? So in an environment of rising market rates, so after a lot of people piled into these products, okay, interest rates started going up, and house payments went up very significantly. And another thing that these companies did was they hired appraisers that gave very high appraisals, okay? And so the banks did not require, they did high loan-to-value ratios, loans, and so these people did not have a lot of their own money into these homes, and they walked. They walked. They took the keys, brought them back to the bank. All right. So Dodd-Frank was enacted in part because of this, and we just looked at Dodd-Frank, but let's look at it again. Key provisions of Dodd-Frank, again, when having to do with home mortgages, is that the terms of a mortgage loan have to be disclosed and explained, okay? And you cannot represent that a loan has fixed terms when terms can actually be changed, so you have to be very careful with that. When you write a law like this, if the law is violated, people can be prosecuted and sued. That's a big purpose of the law. And this is interesting, and this is something I didn't know about. Lenders who are pooling and securitizing mortgage loans that they create and sell are responsible for at least 5% of the credit risk. So what that means is that if a mortgage lender makes a loan, sells the loan, they still are on the hook for 5% of any credit losses, at least 5%, that are attached to the mortgage that they sold. What does that mean? That means that lenders have to pay closer attention to the people they're loaning money to. That's what it means. So that's a really cool thing. I love that idea. Okay? So before that, lenders had no responsibility or accountability, and so as long as the loan met the underwriting standards of the agency that was purchasing it, the lender did not really do their due diligence. Okay? So a lot of bad loans were made. All right, so during the crisis, a lot of households sought protection, okay, from creditors, from the banks, under the U.S. Bankruptcy Code. The problem was, and remember that the credit crisis, the mortgage crisis, happened in 2008. In 2005, under the Bush administration, they cracked down on some of the bankruptcy laws because they were too relaxed. They were too easy. And so they made filing for bankruptcy more expensive and time-consuming. Okay, so they made it tougher on people to file. Okay, and so you have to go through a process of completing a counseling program. So it's not easy to file for bankruptcy. And the goal was to discourage consumers from taking on too much debt. And as I say in here, it didn't work. Okay, this law did not work. A lot of predatory lending went on. A lot of bad decisions were made by consumers. They took on those adjustable rate mortgages and those interest-only mortgages and borrowed too much money and didn't put enough money down. And the banks and consumers got into big trouble. All right, let's go ahead. As I said, here we go again. This will be easier though. This will be quick. New chapter. All right, let's get this done. There we go. All right. So there are two forms of bankruptcy that I want you to be familiar with. The first is called Chapter 7, and it is a liquidation. And it is the more serious form of bankruptcy, Chapter 7. And under Chapter 7, the court, there's a bankruptcy court, a separate court that is set up for bankruptcies. They take possession of all of your assets, and they sell all of your assets, and then they use the proceeds to pay the debt that you owe. And of course, debtors are either senior or junior, which means where are they in line? Are they in front? Are they going to get paid first or second? Okay. And if the proceeds from selling the assets are insufficient, then people who are owed money are not going to get paid. And that's the way it is. Everybody loses. Okay? And then the second type of bankruptcy is Chapter 13, and it is called a reorganization, not a liquidation. Okay? So the filer, the person who files for bankruptcy, keeps their assets and files a plan that the court approves, and the bank works with the lenders to reschedule the debt. Okay? And the filer will typically pay either part or all of the debt, but they reschedule it so that the filer has the more time, lower payments, and has the capacity to pay that debt off. So Chapter 7 or Chapter 13. And so a means test is done to determine if you file under Chapter 7 or Chapter 13. And what this means is, well, let's go ahead and let me show you the definition of this. So the means test is an average of the debtor's past 6 months of gross income. So what is the capacity of the filer to pay? And so the test is done to determine if the filer can pay. If the filer can pay the debt, then they can't go through Chapter 7. Okay? This is done to keep people from trying to avoid their debt when they can actually afford their debt. That's what this is, okay? So if you have enough income, you're not going to be able to file Chapter 7. You're going to have to file Chapter 13 and pay your debt. That's what this is. All right, just a couple more slides. Okay, so some other terms that you need to be familiar with in banking. The annual percentage rate, the APR, we go over this in ManFin, and it is defined in the Truth in Lending Act. Okay, so it's a specific formula, whoops, and lenders have to give the borrower a statement that states and specifies what the APR is so that the borrower knows exactly what their APR is. And the APR is the annualized, it's an annualized number, an annual number, and it's the internal rate of return that equates the total payments with the amount of the loan. So basically, it is the internal rate of return, and it is one way to compute what the rate is on a loan. And it's a formula that is standard. It's a formula that is accepted by all the banks. Because it's standard, because it's accepted by all the banks, then a customer can compare the APR for different loans and understand how to do the comparison. Okay? All right. I don't really like that. We're not even going to look at that. All right. So comparison is the important thing. Let's see what we have here. Then we have simple interest. Oh, man. I made some changes to this thing, but that's all right. We'll go ahead and do it this way. So simple interest is when you take the rate times the principal times the amount of time to determine how much your interest charge is going to be. Okay? That's not really important. Then you have the discount rate method. Okay? With the discount rate method, when you go to the bank and you take out a loan, they say, okay, we're going to loan you $100,000 and it's going to cost you 10%. So you pay $10,000, so they loan you $90,000 and they take $10,000 out of it and you pay the interest up front. Okay? That's what the discount rate method is. And then under level pay amortizing, it's an installment loan, okay? And it's a fixed payment on a regular schedule that includes interest and principal. Okay? Interest is computed for each period and is separated from the payment. Okay? Now, let me say this. I made some changes in this chapter, and I am going to post the changes that I made. In fact, I'm gonna stop this right now because I want you to see the changes that I made. It's important. So bear with me. I'll be right back.